Okay, now that you've got your company formed, set up, possibly even a business bank account in place, all the necessary registrations with HMRC Companies House are either underway or have been done, and various things like VAT are going to be considered as well very shortly. Okay, what we're going to explain here is, well, how does the accounting generally work, the accounting and tax, shall I say, generally work for a contractor freelancer limited company. Okay, now I'm going to explain here using a very generic example. So let's just call you Bob, okay, and let's just imagine you are an IT contractor. Now, as an IT contractor, you may have secured yourself a contract or in the process of securing yourself a contract. Now, one of the most common things here in the UK is that there's an agency involved. Okay, the agency obviously is your recruitment consultant or middleman, whoever it may be, okay? And contractually, once you secure a contract, what normally happens is there's a contract in place between your agency and your limited company, and the agency then has a back-to-back contract with your end client. Although having said that, Bob here physically will go in and procure his services to his client, okay? Not necessarily always at their premises, more than likely it will be. Sometimes it can work from home or sometimes it can work remotely, but no doubt they are accountable and deliverable to the end client there, okay? Now let's just imagine Bob has, or is on a day rate, and we'll just call that day rate £400 per day. Okay, at the moment we're going to ignore VAT, just to sort of simplify the example. Now, if they're on a day rate of £400 a day, Bob's going to go into his client premises or wherever he may work from and procure his services. Okay, so assuming he works 5 days a week, that's £2,000 for the week. Okay, and let's just assume he works 40 weeks in the year, which is fairly common. Okay, that gives us a figure of £80,000 of income. Okay. Now with Bob, he may invoice his client weekly or monthly. More than likely monthly. It can be weekly. Sometimes it can be longer periods than this, but monthly is certainly by far the most common. So if he's invoicing his client on a monthly basis, okay, he'll get paid on a monthly basis. Okay, and payment is made directly into the business bank account, okay, if one is set up. And we're assuming in this scenario it is. If you haven't got a business bank account set up, I seriously suggest you do get one, okay? So payments made straight into the business bank account, i.e. the physical monies, okay? And that is obviously going to the income line. So that's the income for the company. So the way things stand at the moment, that income belongs to XYZ Limited, not to Bob himself, who, let's assume, is that director and shareholder. Now, the next part is Bob will also incur expenses. The difference between working as a permanent member of staff or in permanent employment and as a contractor is permanent people cannot get tax relief on expenses. Okay, and we're going to go through the typical contractor freelancer expenses. Okay, and let's just take one as an example, travel expenses. When you go from your place of residence to the place or your client's place of work, as a contractor, you can actually put that through as an expense, offset it against income, and actually get what's called tax relief for it. Okay, as a permanent member of staff, you can't do that. You can only pay for your travel expenses from your after-tax money. Okay, so it's a very, very big advantage in terms of contracting through a limited company. Now let's look at Bob's situation. He can offset his expenses. Let's see the typical ones. There's his travel expenses. There is food and subsistence. Okay. As an IT contractor, he may need to buy software and hardware. Just hold that for a minute. If you decide to engage with an accountant, okay, the accounting fees are tax deductible. Any insurance related to the business, such as professional indemnity or public liability. And generally speaking, any expense that is wholly and exclusively for the purpose of your business, okay, becomes an allowable expense. So in this scenario, let's just assume a number, okay? Let's say he's done about £20,000 of expenses for the year. Oh, put the 20 there, okay? And one of those expenses is also going to be a director's salary, which I'll come on to very shortly. Okay, so let's say 80 minus £20,000 gives a profit figure of £60,000. Okay, so the profit of £60,000, and this is assuming a full year's accounts or numbers. Okay, certainly Bob will have that broken down by month or quarter, because that's how frequently he'll need to pay himself, I would imagine, in most scenarios. So there's a profit figure of £60,000. Now, XYZ Limited, because it's a limited company, okay, is subject to UK corporation tax. And at the time of doing this particular presentation, the rate of UK corporation tax is currently 20%. Okay, so that means tax is only payable on the profit, okay, not the top line income. So on £60,000, okay, there is a £12,000 tax bill, which means there is profit after tax of £48,000. Now, I'm just going to come back to the importance of corporation tax. It's a flat rate 20%. It's only assessable on the profits, okay? So actually it depends on the level of your income and the level of your expenses, okay? So the more expenses you put through, the lower your tax bill, okay? The less expenses you put through, the higher tax bill. So that's where people, when they often say, or can you expense this item, the benefit of that is it reduces your tax bill, because actually it reduces your profit. The lower your profit, the lower taxes you're going to pay, okay? But on the flip side of that, the more your expenses are, the lower it will reduce any profit after tax available for distribution as well, okay? So coming back to this now, £12,000 is the amount of tax Bob's company has to pay, okay? Now, the difference between, again, a permanent employee and somebody who operates through a limited company is that a permanent employee pays their taxes every month as they go along, i.e. pay as you earn. In a limited company scenario, that's not the case. The corporation tax, in this particular example, isn't going to be paid or payable until well after the 31st of Jan 2016, okay? And in fact, you've got up to 9 months after the end of your company year to pay your tax. So there's a very long delay between your trading period and actually getting the tax paid. So that amount of money will start building up into your business bank account. What you've got to be very careful of is that you're not spending it. Now that brings me on to profit after tax. So profit after tax is the amount left after you've accounted for the UK corporation tax. Now profit after tax is the amount Bob can pay himself as a dividend. Okay. And a dividend is essentially a reward for his shareholding. If he owns 100% of the shares, he's entitled to the full £48,000. If he owns 50% of the shares, he's entitled to 50% of the £48,000. Okay. Now Bob in this scenario is the director shareholder, and it's up to Bob to decide through his own decision making whether he wants to pay himself a dividend. If so, how much of that £48,000 and when. The discretion is entirely his. So Bob's going to decide on the amount of dividend. More than likely he's going to want to take the whole amount. Now with a dividend, the beauty of a dividend is as you're accruing or a dividend entitlement is building up, you can pay a dividend as frequently and as often as you choose to, okay? The only criteria with a dividend, or the only criteria of a dividend, is two things. Number one, you must only pay a dividend from after-tax profit, okay? You cannot go and pay yourself an equivalent of 60,000 on a monthly basis, because what you're then doing is giving yourself the tax money as well. Not allowed to do that. It's actually illegal under company laws, the Company Act 2006. Profit after tax is what you can pay. As long as you stick within those limits as a maximum, that's fine. You can actually distribute anything lower than that. Secondly, if a distribution is made, it's transacted properly from the business bank account, okay, to Bob's personal account. Okay, so let's say Bob's got a personal account over there, all right, and the transaction, and I'm just going to bend that arrow there, must go to his personal account, and the transaction must be clearly labelled. Third thing, with that transaction, the correct and necessary documentation, i.e. dividend vouchers and board minutes, must be in place to evidence and to support the dividend, okay? And that is something an accounting service can certainly help you with. Now, that's one way for Bob to pay himself. The other way is through a director's salary, as I mentioned up here, okay? Now, what's the difference between a dividend and a director's salary? Well, a dividend is just that. A dividend is a reward for shareholding, okay? Whereas a director's salary is more or less what it says it is. It's a salary to the director, okay? Now, Bob has to be a director to earn that salary, okay? Other directors of the company can also earn a salary, as long as it's justified, okay? Now, the director's salary is payable on a monthly basis, okay, normally, and it's paid again to the personal bank account of the directors. So in this case, we're just going to say it's Bob, and it will go monthly to his personal bank account, okay? The other thing with a salary, it is administered by the PAYE payroll system, okay? So akin to being a permanent employee, what you probably would have received are pay slips from your employers every month, okay? And the pay slips clearly tell you how much you've earned, how much tax, national insurance has been deducted, and what your net pay is at the end of it. So in other words, how much you've physically been paid into your bank account, okay? It works exactly the same here. But the difference is the director's salary that you would normally pay in a contractor situation is what's called a minimum director salary. So in other words, it's a minimum amount to avoid paying any national insurance and tax. Now, this is by no means illegal. This is totally legitimate, and it's totally common practice, well known to HMRC. As we currently stand in the 2014-15 year, for example, the minimum salary can be up to £10,000, which avoids any payment of tax, and that matches the personal allowance for any UK tax resident. There would be a small amount of national insurance payable on that, but it is very, very minimal. So they're the two ways Bob will pay himself: director's salary and dividends, normally on a monthly frequency, but the dividend can be less frequent than that, should Bob choose and decide to. Right, so in this scenario here, and a typical scenario is, Bob needs to make another consideration, whether he wants to register his company for VAT, i.e. value-added tax, or not. Okay, now let's look at that. First of all, there is a income threshold for VAT. In the 2014-15 year, as an example, that currently is £81,000. So what does that mean? That means if your income for the year will or is due to exceed £81,000 a year, that means you must register your company for VAT. Okay, it's absolutely compulsory. If it's not due to hit that level, okay, any amounts under that, registration for VAT is totally optional. It's the director shareholder's choice. Okay, now that's where we come in. At the end of the day, most people's income probably are going to be around that threshold. If it is lower, what is the advantages? What is the advantage of registering for VAT optionally? Now let's illustrate with an example, or the example of Bob. Now we know Bob's day rate is £400 per day. Let's say Bob decides to register his company for VAT. Okay, if he does, he's then obliged to charge his end client the standard rate of UK VAT, which is 20%. So by adding on 20%, Bob's day rate goes to £480 per day. £400 a day being his fee, £80 per day being VAT. So he will invoice the equivalent of £480 per day to his client. Okay. Now, if his client is a VAT registered organisation, in which case most will be, they will have absolutely no problem with actually paying him across £80 a day in VAT. Reason being, because they're VAT registered, well, they will just go back and claim that £80 back from the revenue. Now, here Bob is invoicing for £80 per day. What happens with VAT? There are two schemes. When I say two schemes, these are two schemes that are most relevant to contractors. There are other schemes, but they are actually not too relevant at all. Number one is the standard scheme of VAT. Okay, now that simply means if Bob has collected £80 from his client in VAT, what's called output VAT, but he has incurred £30 of VAT, called input VAT, on his expenses. So let's say, for example, accounting fees and other types of expenses do attract VAT, okay? In which case Bob will pay whatever the fee plus 20% to his suppliers. Let's just say that turns out to be £30 at the end of the day. What then happens is he's collected 80, he's paid 30. The difference just needs to be worked out, which is £50 here, and that difference is then paid to HMRC or the VAT office. Okay, that is an example of the standard VAT scheme.